Hello, passive investors. Welcome to Passive Pockets presented by Equity Trust. I'm your host, Jim Pfeiffer. A critical part of investing is knowing who you're investing with. So today I am excited to talk to Paul Bennett from AAA Storage. So let's get to it. Paul, we just had an awesome time with you at the Passive Pockets conference. We appreciate your support. You know, did you have a good time at the conference? I guess the first thing I want to ask.
Yeah, well, Jim, first of all, it's always good to hang out with you. Yeah, the conference was amazing. We were so impressed by the information that was provided to investors, and also really blown away by the opportunity to meet at least a piece of the Passive Pockets community, get to know some of the investors and LPs, and we thought it was absolutely fantastic. We really enjoyed it.
Well, we really appreciate your support. Glad you could make it. I had a great time as well. But let's get into it. Can you tell us a little bit about AAA Storage? What type of real estate do you focus on? Storage is in the name, so I'm going to guess, but just kind of give us an overview of the company.
Yeah, absolutely. AAA Storage is primarily a self-storage and office industrial flex developer and operator. We are vertically integrated, so we not only develop properties, but we operate them once they have a certificate of occupancy or in lease up. And what we really focus on is providing multi-property investments for limited partners who want to make passive investments that are growth oriented. We're not an income play because we're doing ground up development. So, and our strategy is to sell properties when they reach stabilization, which also happens to be about the time they begin to produce free cash flow. So it's really a growth oriented investment. We've been at it for 32 years. We've got 90 full cycle deals that have provided a very attractive 19% IRR to our investors over that 32-year period. And our current offering is Growth Fund 2, which will be developing 8 self-storage properties and 3 office industrial business parks in Texas and North Carolina.
Excellent. Can you just talk a little bit about the Flex product and how that differs from self-storage?
Yeah, it's different, and yet it's very similar. Office industrial flex is a type of real estate that has a very broad tenant base. It's the type of place where in your local market you'd find a home services business, maybe pest control, or a plumbing contractor or HVAC contractor. We have a lot of last mile logistics and internet-based businesses that rent space from us in the office industrial flex product. And essentially it's small bay industrial where you have a 2,000, 3,000, 4,000 foot bay with 1,000 or 1,500 square feet of office in the front and 1,500 to 2,500 square feet of warehouse in the back with a roll-up door. Where it's similar to storage is that we build what I would say is a Class B product. It's slab on grade, metal building with a 30-foot clear span ceiling. And so it looks like a storage building on steroids a little bit. But the other way it's very similar to storage is the financial dynamics, the yield on cost and the returns and the value that can be created in development are extraordinary. And so we think it's a great product. It lines up well with what we've done for a very long time. And we started building Flex about 12 years ago. So we've done a number of flex projects, in Texas and the Carolinas and a number of different markets.
Awesome. Okay, so I want to get into the real estate part of this. I know you've been doing this for a long time, but how and when, but how did you first get into the world of real estate?
You know, Jim, I think I told you that story at dinner the other night. I'm trying to think if I can make it a really short version. It was totally by chance, if you want to be honest. I was working as a bartender in a hotel at age 21 that was owned by a real estate syndicator. And one night he was in the bar and I think maybe had one cocktail too many and was talking a little big and told me he'd give me a job when the summer season was over. So Labor Day came and went. I packed up my stuff and drove to Winston-Salem, North Carolina, knocked on his office door and said, "I'm here for my job." And he looked a little bit like a goat staring at a new gate. But he honored his promise and gave me a job, and that was in 1981 or 82. And I've been in the real estate investment business, a lot of it syndication oriented, but not all of it. I've also been a principal from a development and real estate ownership standpoint outside of the syndication world. But since then, which is, gosh, what is that, 40 44 years, something like that, 43, 44 years. So.
Yeah, that's a long time. And I am going to make a guess here. I'm sure I've made a lot of mistakes, and my career isn't nearly as long in real estate. I assume you might have made a few mistakes along the way. Can you talk about maybe something you've learned from a mistake or two that you've made along your path, along your journey?
The biggest debacle that comes to mind, I'm trying to sort of codify the lessons that came out of it, is in the early 1980s, in the early mid-1980s, it was a very tax-motivated environment. The investments really became more about the tax benefits that you could get from them than the real estate, the economics of the real estate itself. And highly leveraged deals that were were geared to create 1.5 and 2-to-1 write-off, so $2 of tax deduction for every dollar that you invested. And it so distorted the economics of the real estate itself that in 1986, when TEFRA, the Tax Reform Act, was passed, and took away about 25% of the value of all commercial income producing real estate because it stripped away a lot of the tax benefits. The deals were over leveraged. They hadn't been focused on economics. And when that tax piece was taken away, a lot of deals saw significant issues. And so I guess the lesson from that is you can't ever stray from the underlying economics and economic objectives of owning real estate. Yes, you get some tax benefits, but that shouldn't be priority number one. It really should be about deals that are vetted, structured, and executed in a way that's all about maximizing the economic benefits of the real estate.
Yeah, and I think as you were explaining that, there were some echoes to what we've recently gone through, not necessarily with tax, but with interest rates, and everything was focused on the interest rate. And then when that changed, you have a bunch of deals that were in trouble. So it kind of mirrors that a little bit. One little thing changes and everything blows up, right?
Leverage is a good thing, but it's a sword that cuts two ways, right? It can increase returns, but if you don't have your feet spread wide enough, if you're not financially capable to carry that leverage through a difficult period, because you don't always control what the market and what the environment's going to do. I had another experience. We bought a piece of land in 2006, and you can just think about that for a minute. That was at the peak of the market. 08, 09 hit, and not only did everything lose value, but you couldn't develop because you couldn't get loans. We went, and then we ran into some zoning issues and other things, but we actually had debt on that property. We paid it off so we could squat and real estate investing, like business, is a game of time and money. The more money you have, the more time you have. And so we were able to pay off the loan on that property, sit on it for 15 years before we actually developed it, and wound up with a very successful mixed-use project. But had we not had the financial capability to pay that debt off and weather that storm, we'd have taken a beating. So,
yeah, well said. So now I know that you invest heavily in your own deals.
Yep.
Do you own also real estate outside of that? Are you a syndication investor, an LP in other people's deals?
I am. I've been an active, passive investor in not just real estate. In some more exotic times, I've invested in cattle, oil and gas, some other asset classes, but I've predominantly stayed in real estate. And yeah, there are several syndicators. One in the multifamily space that I particularly like. Although I've done some multifamily deals earlier in my career, it's not my area of expertise. And so just like every passive investor, I look for a sponsor who can provide that expertise in a specific market and invest with them. So absolutely, I think right now the non-AAA deals that I have that are active are all multifamily, and they're with a group, Stephen D. Bell out of Greensboro, North Carolina. Very, very, very good syndicator out of the state of North Carolina.
And so our community, as you know, LP investors, we're all working towards financial freedom, whatever that means to each individual. It's all different. Now, I'm making a guess here, but you've been in this business for a long, long time, and I'm going to assume that you don't have to be doing this anymore. So talk about what financial freedom means to you, and just kind of encapsulate that for us, because you have been around a long time and you probably have other choices, right?
Yeah, people ask me, so I'm 66 years old, Jim. People ask me, when are you going to retire? My answer is never. And the reason, as long as God allows me to have a brain that works, and because I don't dig ditches for a living, I've been blessed to do something that's predominantly with my mind and in relationships, and I enjoy it. And so I don't think I may have a little more flexibility 5 or 6 years from now and less day-to-day responsibilities, but I'll never not do what I do, and I plan to end my career, taking AAA Storage to the place it can be. Financial freedom for me is the ability to get up every day and choose what you're going to do without thinking about money. And that doesn't mean you have to have lots of money. It just means you have to manage your lifestyle so that it stays within. But I am very thankful for the opportunity to invest my time in the ways that I want and do the things that I enjoy or am fulfilled by without having to think about the economic benefit that's attached to it.
Yeah, that's really well said. So the final question I have for you today is, what is the most important thing or something that is really important you think passive investors in syndication should learn to do or to maximize their success in this style of investing?
This will sound a little self-serving, but I think it starts with the sponsor. We think of our investors as our partners. And so if you think about passive investing like it's the same thing on a bigger scale as having a partner that you invest in real estate with, you would want a partner that has certain characteristics. You'd want them to have experience. You'd want them to be trustworthy and transparent. I think it really starts. You can do a great deal with a bad sponsor and still wind up with a suboptimal result. You can do a mediocre deal with the right sponsor and get a pretty good result. And so, right. Again, I know it sounds self-serving, but I do think it starts. That's the foundation that every successful investment starts with, and then investing consistently. If you live at the beach in North Carolina, if you don't live there, if you're there for a week's vacation every year, you'd say there really aren't much in the way of waves on the coast of North Carolina. There are. You just have to be there every day. And I think deals and investments are the same way. Invest consistently over time, and in real estate, and I think you'll see an overall return and growth in your net worth that will achieve your objectives.
Yeah, I couldn't agree more. It's not a get-rich-quick scheme. It's a build wealth slowly strategy, and I couldn't agree more. So that wraps up our interview today with Paul Bennett. Thank you so much, Paul, for being part of our community and supporting Passive Pockets. We appreciate you.
It was a pleasure, Jim. Always good to get together.
Awesome. So for those of you viewing, be sure to check out our YouTube channel and subscribe to our podcast for more great insights into the world of syndications. Thanks for tuning in, and as always, happy investing.